In 1971, the United States did something quietly extraordinary. It severed the final link between the dollar and gold, and in doing so, changed the nature of money itself. Most people think debt is simple. You borrow, you owe, you pay it back. But that's not how modern debt actually works. Because in the system we live in today, debt isn't just something we use, it's something we create money with. And once you understand that, everything about the economy starts to look different. Let me show you what I mean. Right now, as you're watching this, there's roughly $90 trillion of debt in the global financial system. 90 trillion. That's more than the entire GDP of every country on Earth combined. And here's the part that doesn't make sense at first. If debt is money we owe, where did all that money come from in the first place? The answer is uncomfortable. It came from the debt itself. Let me take you back for a second. Before 1971, the dollar was backed by gold. If you had a $100 bill, the U.S. government technically owed you a specific amount of gold. The system had limits, physical limits. But when President Nixon ended that relationship, something fundamental shifted. Money was no longer a claim on something real. It became a claim on trust. And trust, unlike gold, can be expanded infinitely. Here's how it works now. When you walk into a bank and take out a loan, let's say $50,000 for a car, you probably imagine the bank is lending you money it already has, maybe from someone else's savings account. But that's not what happens. The bank doesn't take money from a vault and hand it to you. It creates new money out of nothing. I know that sounds absurd, but this is standard practice. When the bank approves your loan, it types $50,000 into your account. That money didn't exist 1 second before. Now it does. And in exchange, you sign a contract promising to pay it back with interest. The bank now holds your debt as an asset. You hold the money as a deposit. But here's the twist. That $50,000 you just borrowed, it's now part of the money supply. You spend it, it circulates, it becomes real money in the economy. And the bank? It just created it by creating your debt. This is called fractional reserve banking. And it's not a secret, it's just not explained this way in school. Central banks around the world admit this openly. The Bank of England published a paper in 2014 titled Money Creation in the Modern Economy. The opening line reads, "The reality of how money is created today differs from the description found in some economics textbooks." That's a polite way of saying what you were taught was wrong. Now, you might be thinking, okay, but there must be limits, right? There are. Sort of. Banks are required to keep a small percentage of their deposits as reserves. In the U.S., that used to be around 10%. But in March 2020, during the pandemic, the Federal Reserve reduced the reserve requirement to zero. Zero. Which means, technically, there is no longer a hard limit on how much money banks can create through lending. The only real limit now is demand. As long as people want to borrow, banks can keep creating. And people do want to borrow. Because in this system, debt isn't just a tool for buying things, it's the engine of growth itself. Governments borrow to build infrastructure. Corporations borrow to expand. Individuals borrow to buy homes, cars, educations. Without debt, the economy doesn't grow, it contracts. This is why central banks panic during a recession. It's not just that people are losing jobs, it's that people stop borrowing. And when borrowing stops, money creation stops. So debt has become structural. It's not a bug in the system, it's the system. And this creates a strange paradox. For the economy to keep growing, debt has to keep growing. But debt, by definition, is a promise to pay something back in the future, which means the system is always running forward, always needing more future growth to justify the borrowing of today. Let me give you a number that makes this clear. In 1971, total U.S. debt, public and private combined, was about $1.5 trillion. Today, it's over $93 trillion. That's a 62-fold increase. In the same period, GDP grew roughly 25-fold, so debt has been growing more than twice as fast as the actual economy. Why? Because we need it to. Every time growth slows, central banks cut interest rates to make borrowing cheaper. Every time there's a crisis, governments borrow more to stabilize things. The system is designed to encourage debt, because debt creates the money that powers everything else. But here's where it starts to get uncomfortable. If debt is money, then paying off debt destroys money. Think about that. When you pay off your car loan, that $50,000 doesn't go back into circulation the way you might think. It disappears. The bank's asset, your debt, gets erased. The money you used to pay it off gets removed from the system. This is why economists talk about debt deflation. If everyone tried to pay off their debts at the same time, the money supply would collapse. Prices would fall. Businesses would fail. Unemployment would spike. We saw a glimpse of this during the Great Depression, and ever since, policymakers have been terrified of it happening again, so we're locked in. Too much debt is dangerous, but too little debt is also dangerous. The system needs growth. Growth needs borrowing. Borrowing creates debt, and the cycle continues. Now let's zoom out, because this isn't just about car loans or mortgages. Governments operate the same way. The U.S. government currently has about $36 trillion in debt. Every year, it spends more than it collects in taxes. The difference is covered by issuing bonds. Those bonds are bought by investors, banks, foreign governments, and even the Federal Reserve itself. And what do those buyers get in return? A promise. A promise that the U.S. government will pay them back, with interest, sometime in the future. But here's the thing. The government never actually pays it back. It rolls it over. When a bond matures, the Treasury just issues a new bond to pay off the old one. It's been doing this for decades. The national debt hasn't been paid down in any meaningful way since the 1830s. And that's fine, as long as people keep believing the U.S. will honor its promises, as long as the dollar remains trusted, as long as the system holds. But trust is a strange foundation for a global economy, because trust can evaporate. We've seen it happen before. In Weimar Germany, in Zimbabwe, in Venezuela, when governments print too much money or borrow too recklessly, people stop believing the currency has value, and when that happens, the whole thing unravels. Hyperinflation, collapse, chaos. Now, the U.S. is not Weimar Germany. The dollar is still the world's reserve currency. Most international trade is conducted in dollars. Most central banks hold dollars as reserves. That gives the U.S. an extraordinary privilege. It can borrow in its own currency, and it can, if needed, print more of that currency to pay its debts. No other country has that kind of flexibility, but even that privilege has limits, because the more debt you accumulate, the more interest you owe, and right now, the U.S. government is spending over $1 trillion a year just on interest payments. That's more than it spends on defense, more than it spends on education, infrastructure, or most other programs. And as debt grows, so does the interest burden, which means more borrowing, which means more debt. You see the problem? Some economists call this the debt spiral. Others are less dramatic. They argue that as long as the economy grows faster than the debt, it's manageable, and for a while, that was true. But growth has been slowing. Productivity gains have stalled. Populations in developed countries are aging. And the easy wins, cheap oil, globalization, technological revolutions, are harder to come by now. So what happens when growth can't keep up with debt? One option is austerity. Cut spending, raise taxes, pay down the debt. But austerity is politically toxic. It leads to recessions, unemployment, social unrest. Very few governments choose this path willingly. The other option is inflation. Let the currency lose value. Make the debt easier to pay off in real terms. This is what happened in the 1970s. Inflation soared, savings were eroded, but debt became cheaper. It worked, kind of, but it also hurt a lot of people. And then there's the third option, the one no one talks about directly. Default, not in the traditional sense. The U.S. won't just stop paying its bonds. But there are softer forms of default, letting inflation run higher than expected, changing the terms of Social Security or Medicare, restructuring obligations in ways that technically aren't a default, but function like one. History is full of examples. Russia in 1998, Argentina multiple times. Even the U.S. has done it before, in 1933, when it devalued the dollar against gold. The uncomfortable truth is this: debt in the modern system is both necessary and unsustainable. We need it to grow, but we can't keep growing it forever. Something eventually has to give. Now let's talk about you, because this isn't just a government problem. Household debt in the United States is over $18 trillion. Student loans, mortgages, credit cards, auto loans. The average American household carries over $100,000 in debt. And for many people, that debt feels crushing. But here's the paradox. Your debt is someone else's asset. The bank that holds your mortgage? That's an asset on their balance sheet. The investors who bought bonds backed by student loans? They're earning interest from your payments. Your obligation is their income stream. This is why debt is so hard to escape. It's not just a personal burden, it's woven into the financial system itself. Pension funds rely on it. Insurance companies invest in it. Entire markets are built on the expectation that people will keep paying. If everyone stopped borrowing, if everyone paid off their debts, the system wouldn't celebrate. It would collapse. And this creates a moral hazard, because the system needs you to stay in debt. Not so much that you default, but enough that you keep paying. Enough that you keep working. Enough that you keep consuming. Debt, in this sense, isn't just financial, it's social control. I'm not saying this to be conspiratorial. I'm saying it because the incentives are clear. Governments benefit from inflation because it reduces the real value of their debt. Banks benefit from lending because that's how they make money. Corporations benefit from consumer debt because it drives spending. Everyone in the system has a reason to keep the debt machine running, except maybe you. So what do? You can try to opt out, pay off your debts, live below your means, save in assets that hold value, and many people do. But even that has limits, because you're still using the currency. You're still participating in the economy, and the economy runs on debt, or you can accept it. Understand that debt is a tool. Use it strategically. Borrow for things that generate value. Avoid high-interest traps. Play the game carefully. But know that you're still playing. There's a quote, often attributed to Henry Ford, though the exact source is unclear. It is well enough that people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning. Whether he said it or not, the sentiment holds. Most people don't understand how money is created. They don't know that debt is the foundation. And maybe that's by design, because if they did understand, they might start asking harder questions. Like, why do we accept a system where money only exists if someone goes into debt? Why do we tolerate a structure that requires infinite growth on a finite planet? Why do we allow the people who create money out of nothing to charge interest on it? These aren't radical questions, they're reasonable ones, but they don't get asked very often, because the system works, mostly. For now, it's given us unprecedented wealth, technology, comfort, but it's also given us inequality, instability, and a future mortgaged to the present. And here's the final twist. Debt doesn't just bind you to the past, it binds you to the future. When you take on debt, you're making a bet that your future self will be better off, that you'll have a job, that you'll earn more, that the economy will keep growing. And for a long time, that bet paid off. But what happens when it stops paying off? What happens when wages stagnate, when costs rise, when growth slows? Then debt stops being a tool. It becomes a trap. We're starting to see that now. Student loan borrowers who can't afford to buy homes. Retirees whose savings have been eroded by low interest rates designed to encourage borrowing. Entire countries like Japan, where debt-to-GDP ratios have climbed above 250%. The system is straining, and no one knows exactly how much strain it can take. Some people think we're heading for a reckoning, a debt crisis that forces a reset, maybe through inflation, maybe through default, maybe through some new financial architecture we haven't imagined yet. Others think we can keep managing it, that central banks are smart enough, that governments are flexible enough, that innovation will create the growth we need. Maybe they're right, but maybe they're not. Because here's what history shows. Every system that relies on perpetual growth eventually hits a wall. Rome, the Dutch Empire, the British Empire, they all believed their systems were permanent. They all believed they'd found the formula, and they were all wrong. So is our system different? Is modern debt-based money the exception? Or is it just the latest version of an old story? A story where we borrow from the future until the future runs out. I don't have the answer. Neither do the economists. Neither do the central bankers. They're making it up as they go, just like everyone else. But here's what I do know. Debt isn't what you think it is. It's not just a loan. It's not just an obligation. It's the invisible architecture of the world you live in. And once you see it, you can't unsee it. So the next time someone tells you the economy is doing great because GDP is up, ask them how much of that growth came from borrowing. The next time a politician promises prosperity without pain, ask them how they plan to pay for it. The next time a bank offers you credit, ask yourself what you're really signing up for. Because in this system, debt is never just debt. It's power, it's control, it's the future, sold to the highest bidder, and the bill is always coming due.